Hello, welcome to FinTrail's FinCrime Spotlight, a mini digest covering current and topical issues related to financial crime. I'm Ciara, and I'm joined today by James and Greg. So this week we're discussing TM and ongoing monitoring. Often we see it as a common theme coming out of our audit recommendations, and it keeps popping up with other regulators. We've seen in the past some good examples on transaction monitoring guidance coming out from MAS in Singapore and DNB in the Netherlands. So last week, the Bank of Lithuania released a guidance doc on industry best practices for ongoing customer monitoring. And I think whether you're regulated in Lithuania or not, it's a very practical document that's probably a worthwhile read for firms, large and small, looking to implement or improve transaction monitoring capabilities. But if you're short on time this week, we can take 5 minutes to go through some of the highlights on it. So James, over to you. Do you want to touch on some of the key aspects covered in the report and some of your thoughts from it?
Sure. I mean, I love these kind of regulatory kind of guidance docs. Breath of fresh air to get something actually practical for once, which is always nice. So I think that's why we're signposting it. Ultimately, it's good to have something practical that you can refer to. It's guidance, right? It's not regulation. So regardless of whether you're licensed in Lithuania or not, it's still useful to reflect and refer to. And I think the reason, other than it being practical, is it covers, I guess, the end-to-end kind of TM ongoing monitoring life cycle for consideration. So, what are the steps that you need to actually consider when you're choosing or selecting that tool? What do you need to do when it comes to kind of configuring it and rule setting? Even this week, Greg, I know we've had a client that's been inquiring how they justify the parameters of their transaction monitoring settings in terms of, date, time, volume, value, all that jazz. So, and then going down to assurance as well. So it's covering, what you need to do once you've implemented to assure it and ensure that it's working effectively as well. So it covers the whole end-to-end cycle, which I think is really, really useful and practical.
And let's not forget at this stage, still UK AML regulations, as well as Lithuanians, flowing still from the fifth money laundering directive amendment. So actually, if you look at the expectations or rather requirements and the MLR regs in Lithuania and UK specifically about money transaction monitoring, you will find exactly the same things about the complex transaction with no economical sense and things like this. So actually, whether the argument would be that does even matter where you regulated, you still kind of be talking to you, but it is guidance, not regulations.
Yeah, and I think drawing from a number of different sources is always helpful when you're looking at rolling out new solutions, or even sort of when you're assessing what you have in place. And I think feeding into that, assurance and transaction monitoring testing assurance is probably a key area as well. And I think the report does outline some of the good principles on this. And I think, Jared, do you want to maybe take some time and to sort of discuss that and add about some experiences you have around TM assurance testing?
Sure. Well, it's not only principles, but also good practice, which goes beyond what you will see probably in JMSG, which we kind of take as a kind of go-to place always. Not only us, even the firms we work in other countries, they say, we're more than happy for you to look at this from JMS perspective because our regulator has not published anything in that space. So actually, we're just relying on this as well. But speaking of this document specifically, what that like or this part in particular, it really takes time and effort to explain firms and put it in one place, really, what the expectation would be from performing that periodic holistic review of your transaction monitoring processes and everything related to it. And it also drives distinction between automated and manual processes. And let's face it, some of our kind of younger clients, let's call them, they still do have that manual processes, and there's nothing against that as long as you keep on top of that and make decision as and when is not longer appropriate for your firm to have it as a manual. When it comes to automated, it kind of nicely combine, different things you should look at. Some of those might be obvious for more mature firm, but I think especially for the younger firms, that's super important to remember. Is your monitoring cover all the activities? Is it covering your internal funds movement? Is it covering all your products? Are your rules covering the risks flowing from your national risk assessment? Are those rules bespoke to your business model rather than you just took them off your vendor and have never actually looked at them, and then you're surprised why you're not catching anything? It also challenged companies to look at the transactions which didn't trigger any alerts. Is there any reason why they're not triggering? Is there any other risks which have not yet been identified? It also challenged firms to look at their SARs and to see, are there any common threads which should then translate into new rules? So I think there's lots of very, very interesting kind of things for firms to look into. And finally, there is a couple of sentences which kind of I thought it was very, very important for the firms not to overstate that. And let me just quote that, because whenever I find something interesting, I always copy and paste and keep it for later. And what they said there was that it is important to note that such a review, so when it comes to reviewing alerts, should not attempt to manipulate the test results and artificially reduce the number of alerts generated. So basically what the regulator is saying, if you do have a fairly large base of high-risk customer, then you should expect to see fairly large number of alerts. And then the way to address it is not by, reducing or increasing your thresholds to reduce that number, but rather, do you have a relevant resources to deal with that? And something which I think very often firms just came to a conclusion, well, we cannot cope with that, so we will just change the threshold to something a bit higher.
No, I agree. And I think you drew out an important point around sort of how can you make sure that your TM controls are effective as well. And this is a bit we're talking a lot about at the minute, effectiveness. And I think using your own internal data, SARs, for example, maybe production orders that you're receiving, and to say, right, do we need to tweak and change these to make this more effective for the risks that we're seeing? And then I suppose from that then, James, like not surprisingly in this, like risk assessments called out as a bit of a cornerstone for informing TM controls and scenarios. And Greg, you touched on it at the start of what you were saying. So in practice, and what do you see that firms should be focusing on and drawing upon when building this out from a risk assessment perspective?
I mean, risk assessments broadly, like people do conduct risk assessments okay generally, and some maybe badly as well. But using it as an isolated control area or assurance area, and not even connecting to the dots for the wider framework is generally just something we see done particularly poorly in the industry, well, cross sector actually, and not even one particular industry. So you spend all this time and effort doing your risk assessments. Ticket done, see you later, it's done, submit it to the regulators or banking partners, and generally meets regulatory requirements, but you don't actually use it to drive downstream understanding of finessing your controls, making it bespoke to your inherent risk. And this is obviously the same principles and what they highlight in this guidance document as well. If you do a really good, robust risk assessment and spending lots of time highlighting your inherent financial crime risks and how they may manifest themselves into your program, clearly that puts you in a really beneficial position to say, oh, actually, these are the controls that I need to actually implement, or this is how I need to configure this control to make it relevant to kind of the risks that I face in the business or we face in the business. And it really tells the story of, and I think that's what the regulators really want you to do as well, be able to give you the narrative or tell the story of, this is what we think our risk is. This is why we're adopting this control. So if you're a business that has extremely, more exposure to money mules and APP fraud or tax evasion or whatever, clearly, if you've documented in your risk assessment and then you've linked your controls against that risk assessment, it sells a story. You're going to be monitoring the right things, basically.
Yeah.
I mean, that connectivity is super important and to work both ways, right? So on one hand, you would expect some of the risks from your risk assessment to then to be translated into the rules, because but vice versa, sometimes your transaction monitoring throw out some of the new risk, which you did not consider in your risk assessment. So that should go all the way way back to risk assessment, actually update those risks, and then continue assessing whether your roles are actually addressing them sufficiently. And one final, I think, important topic, which again, I think is quite overlooked, is about staff understanding what they're monitoring and what they're monitoring for and how that tool is supporting them. It's not unusual, and I've seen that one or two audits where we look at a transactional monitoring tool, where the tool itself would not actually tell analysts why the alert was triggered. And so there's alert trigger on this customer, and you just need to work out which rule actually triggered for that. And that's not, that's not the best practice. That's not the way to do that, right? So your analyst should really understand the inherent risk your transaction monitoring trying to address, and also the tool itself should should give them that information as well, so they really understand when they're investigating what they're investigating for. As much as also having an open mind in terms of, is there anything else behind that which we have not considered?
Yeah, I think that's an important point. And actually, I did a webinar last night with ACAMS, and one of the guys on it talked about using the risk assessment and giving it to new people who've joined the team. So understanding the risks that the business is facing will then help them inform when they're doing, and he heads up intelligence there in the US, investigations, when they're working alerts, etc. So I think providing people who are sort of involved in these processes some of that broader context and the specific awareness as well, I think is very important. Great. Well, thank you both. I think worth a read for anyone who has the time to go through it in detail, and hopefully you've got some good snippets of some of the considerations coming off the back of it. Cheers, James and Greg. Thanks for your time today, and everyone watching FinCrime Spotlight.